Welcome to the Big Mike Fund podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic. Starting now.
Welcome to the Big Mike Fund podcast. I'm the Big Mike,
Mike Zlotnik, and today it is my pleasure and a privilege to welcome back my really good friend, Dave Van Horn. Hey, Dave.
Hey, Mike. How you doing?
Great to have you back. Dave is a co-founder, and I guess you are a chairman now. Still a chairman. I don't know if executive or non-executive of PPR.
Actually, I am the co-founder and board member. My partner John is executive chairman right now. I held that position for just over 2 years, and then right now John's taking the lead on that. And it's been good, and things are going well. How about yourself?
Yeah, things are good. Thanks for coming back, and we will talk about PPR, what's going on. We are in late April 2025, and the weather is getting super nice. I don't know how it is in Pennsylvania, but New York is a lot of cherry blossoming beautiful out here. I'm sure it's beautiful.
I just got back from Florida. I was in Florida from November to this past weekend. So I just came back for the holiday, and yes, it's pretty up here now. So it's warm enough for me to come back. So
yeah, the people ask what's the best time to come to Northeast, which is New York, Philadelphia, Boston, and the best time, honestly, is late spring and Christmas time, right? Most people will enjoy Christmas festivities or super nice weather before it gets too hot. So it's the best time of the year, truly, to visit Northeast.
I agree. I'm the type of guy that doesn't like to sweat, and I don't like to freeze. So I'm more of a spring and fall type guy myself. But no, it's good to be back. Yeah.
So let's talk about what are you seeing on PPR's front right now? Obviously, again, with the time of the recording, tariffs on, tariffs off, how much? Lots of uncertainty. So there's volatility out there and uncertainty, and it's also creating opportunity for some folks. So let's talk about what are you seeing on your deal flow? What are you seeing on existing investments? We'll cover both the notes business, the build to rent business. I think you're involved with the car washes too, right?
We have a little bit of a couple things, not too many things, but a few things. And you are correct. Sometimes volatility can be a good thing. We were spoiled there for a long period of time. We were in a cycle that was very consistent, I would say. And sometimes volatility creates opportunity, and I'm a believer of that. Now, I don't mind some uncertainty, although we have quite a bit right now. But I think at some point it'll shake out and level off. I know our economist and CIO, for example, has a forecast of where he thinks some of that will land, and will it land between 10 and 20%? The tariffs could be. That's kind of where a lot of it's feeling like, but it'll be yet to see. We tend to be conservative in a lot of these areas, same way with like rate reductions. There was, some of the market is calling for, 4 rate cuts. The Fed was leaning towards 2. That could change, right? That could be, you could go to zero rate cuts till someone gets fired, right? Or someone is asked to leave by 26, right? So there is a lot of that going on. And I think the way we position ourselves is like, none of that's going to happen. And that it doesn't matter, and that if things like that do happen, it's more like icing on the cake. Do you follow that, Mike? Like, even in our acquisitions the last year or so, we act like things are in the current environment. We don't act like rates are coming down or anything. Like, we don't base anything on that. We base things like they're going to stay more of the same. About 2/3 of our book of business is NPLs, non-performing mortgages, 1 to 4 family residential, nationwide. We're in 48 states. we do have a top 10 states. A lot of it revolves around where's the population. But that being said, we purchased right around 400 million in the last year. We anticipate it to be similar in 25. We're not, seeing anything that's giving us signals that it would be anything different. One of the biggest leading economic indicators for that business is unemployment. If unemployment ticks up, which it could, we don't see a dramatic uptick. If it went to 4.5 to 5 or even 5.5, it's not going to dramatically impact our business. Now, if it went up, 6.5 or more, then it would start to be a different story. But unemployment will just create more distress, more delinquent assets, and eventually there is a time lag to the distress space, but it would just create more distressed product at cheaper prices if it were to go, off the rails. So for us, it's really just, knowing what's going on and adjusting. So I'll give you an example. If assets are abundant and cheaper, we're in buying mode. If real estate values are high and there's not high unemployment or anything, then we're more of a seller at that point, right? We've actually done some very good liquidations, a couple good recent sales, a couple securitizations, because the timing was right for some of that. Now, some of that we do hedge our bets based, especially on the securitization side, you're trying to get the best interest rates. So sometimes interest rates impact what we do. But we're not forced to do that. We can hold the assets as performing assets. In fact, we saw that last year where our RPL book of business, which is reperforming mortgages, was up around 50%. And in a normal market, that's about 30% of the portfolio. We got up to about 50%. It was because we were waiting for the rates to come down a little bit. And they did, and we were able to lock in favorable securitization terms, right? So you do have flexibility. It's just like if you owned multifamily and you're collecting rent, the only time you have an issue is if you were forced to sell, so to speak, as opposed to, hey, we're just going to cash flow a while till the rates get better or whatever till the terms get better or till cap rates get better, whatever the story is. You have that flexibility. And we're fortunate too that we're not a one-trick pony anymore. We have other verticals where we could deploy capital. And then we just adjust accordingly, that kind of thing. So it's we have a little bit more flexibility today than in the old days where when you only have one vertical, you're at the whims of the market conditions for that vertical, right?
Yeah, I appreciate lots of great nuggets. Diversification is a key point, having other verticals, which we'll talk about in a second. And it's interesting how you describe you adjust. If the interest rates go lower, you can securitize. If the interest rates go higher, you can buy better. The uncertainty of the unemployment in the economy, obviously, we don't want to see a severe recession, but a light recession is not a major problem. In fact, by some speculation, Trump may be trying to cause a mild recession to either force Jay Powell's hand, cut rates, or to slow things down. Again, it's the technique that's being used that can cause inflation, right? Slowing growth and accelerating inflation is the risk, but in general, uncertainty is what's creating difficult times to make the business investment decisions, and as a result, you have slowing economy. But the thought process, if you ask Trump, of course, he's not trying to cause officially a recession. But unofficially, in my view, maybe he's just trying to slow things down a little bit so that the Fed would be in the mood to cut. And really, the level of current interest rates, it's a fundamental question. We had a drastic shift. We're going to live. This is a higher for longer or higher for good interest rate environment. And I'll just add one comment. These higher interest rates have become the norm for the last couple of years, obviously. And adjustment from here up or down is not going to be as drastic as it was when the rates were at zero. So that change, the impact of the change should not be as severe in either scenario. So any other quick comments on this? And then let's continue with built-to-rent space.
Yeah, you mentioned interest rates. If they come down to any degree, it's beneficial to us.
Well,
And
everyone in real estate, right? That
right,
generally
so
lower
and
rates means better
right.
valuations.
And we're a private equity fund that's real estate backed. So, real estate's a hedge against inflation, right? So all of these things we're talking about tend to be beneficial in our world, whereas not everyone else will fare just as well, especially in traditional markets and things like that, right? That's where you're seeing a lot of impact. But on the real estate side and with the assets we have and the terms we have, we're pretty well positioned. We have long-term financing on most of our holdings and things like that. So we're pretty well positioned. We have pretty favorable terms. If rates come down, we just get more favorable than we already are. It can impact our cost of capital and things like that, but we're pretty well positioned right now. We're pretty optimistic overall, actually. Yeah.
Gotcha. So built to our space, built around B2R. What are you seeing? What are the opportunities? Of course, cost of financing has gone up. Building new assets is harder now. It's just more expensive to build with inflationary pressures, unless you're getting some kind of reduction in cost due to not enough construction starts, right? I've had this discussion with other folks because essentially you have higher cost of financing versus, when the rates were lower. So to build, you have to pay a lot more debt service, and then the outcome still uncertain what people will pay for these assets, either on a sale or to rent. And then the second variable is what it costs you to build. And building is a function of supply demand of projects, right? If a lot of people looking for labor for job, a ton of folks, you have a little bit of softening labor costs. But if you have any kind of tariffs, the cost of material, anything that comes through the over the ocean or through the border, it's going to be a little more expensive. I mean, depending on the actual level of tariffs. So how are you looking at that whole space at both the cost of capital, cost of labor, cost of material, and then ultimately the finished product?
You're saying a lot, Mike. Well, I'll start with this. A lot depends on where you're at, what you're doing, and who you're doing it with. And then it also depends on where you're positioning yourself into the BTR asset class. And I will start by saying that we do like that asset class. We are going into that class. We actually just did an acquisition in Knoxville. We like the asset class. We know what we like is the economic data around it. We like the fact that there's a big shortage of housing, regardless of tariffs. And if you're a long-term investor, we don't see this housing shortage going away anytime soon, especially in the affordable housing space. And then when you look at the demographics of who is utilizing build to rent, whether it's the boomers or the younger people waiting to get their first home or ownership. A lot of this is renting by choice, which is a relatively new category for people to get their arms around. Some people want the freedom. Like, I have a 35-year-old son. He thinks a 30-year mortgage is insanity. He thinks you're an indentured servant. Like, why would you even think about that? Like, it doesn't even enter his radar. He prefers his freedom over why would I want to be locked into one location like that? You guys are crazy, you older people. That's the way his view is. So I'm not saying everybody thinks like him, but there's also a big gap between owning and renting that's pretty significant. And the cost of ownership is dramatically increased, just like rents have, continued to rise too. Now they have leveled off in some markets like Austin or something like that. We just finished a new build in Austin, 101 units, but it's affordable housing. And what's different about that is our end buyer is going to be institutional, and it's really for the tax abatements and things like that. So it depends on what it is. It's hard to paint broad strokes and say, I don't want to invest in multifamily in Austin, for example, because it's overbuilt. Yeah, but it's not overbuilt with affordable. It's not overbuilt with abatement. So it depends on what it is, right? Now, what I like about some of the BTR space that, our company likes about it is that, as you build them, it depends. Are you in the construction phase or are you buying them at CO, like a certificate of occupancy? Or are you buying them to hold long term? And to hold long term is a lot of cases, it's an institutional buyer that it could be an insurance company, a pension fund that wants to hold the asset for 15 years or 20 years. PPR positions themselves more on the front end, whether it was the construction end or at the at CO. Now the deal we recently did in Knoxville, I think it's like 250-ish units. It had two phases, and the first phase was already built, the clubhouses, amenities already done. We actually came in and took the builder out of there, and then we're buying them at CO in phase two. So we're doing like a hybrid, for example. But the risk is reduced dramatically. Now we only intend to hold at most 2 to 3 years until that property fully stabilizes, fully occupancy. Phase one is already at just about full occupancy. So once you stabilize that type of asset, then it's ripe for an institutional buyer to come in and take it out for the long-term hold. PPR's cost of capital is too expensive for us to be a long-term hold investor in a project like that. So hopefully some of that makes sense. But there's some things I like about it, and I'll give you an example. One is in our Austin project, you can't really lease out the units till the building's done because it's really one big building, 101 units, right? And you kind of need the CO on the building pretty much before you can do anything with it. What's nice about build to rent is you can lease them as they're being built. The other thing that we were able to do in our particular case is we were able to lock in the price of the asset. So if there's any increase in cost on construction side, the developer is actually eating that. So it's not a risk to us per se. Now, I guess it could be overall, it could be a risk if they got to a point he couldn't afford to do it or something. But he kind of knows what his costs are. I think they've already acquired a lot of the supplies they need. So a lot of that, factors into some of this stuff. But even on the construction cost, it's yet to be determined. A lot of it's around lumber. Canadian lumber could be impacted, for example, but the US has capacity to replace that. So that's not the same as tariffs on cars, for example. So yes, construction costs could go up. Maybe it goes up 10%. But we don't see that going to, it's not like costs are going to go up 50% or anything. Labor costs is another interesting thing to get your arms around. How much will that be impacted? There is a significant number of undocumented folks in construction. It's estimated around 1.5 million folks, could be as much as 10 or 15% of the construction workforce could be in the undocumented sector. I don't know. It's yet to be determined the impact of some of that. So yes, I'm in agreement with you. We are well aware of costs could go up. But that's where we come in. We're capital, right? So we're able to take advantage of some of these situations where sometimes there is a developer who's not a bad developer. He just has financing constraints, and then we can come in and be of assistance, right? So, but we do like the space. We like some of the geographies that the trick to BTR in some ways, I don't mean to say trick, but you want to be fairly close to the MSA and you don't want to be too far out in the sticks. And I think how do you find land that's affordable enough to make the projects work? And, that's something our due diligence team, that's their job. That's what they do. They have to find these projects in these, markets. They do like some of the Midwest. We are in about a little over half a dozen states that we acquire multi and BTR in. And they're very targeted areas. They're based on a lot of demographic data and a lot of, economic data to pick out these geographies and these partners to be with. Because, one of the other things that's a little difficult is BTR hasn't been around forever. So it's not like multifamily where I could say, hey, I want to go work with, a partner that's been around for 30 years. because BTR, in a way, wasn't really around that long. Although we do own a project in Kansas City that was built in, I'd say, the late 70s or early 80s that were townhouses. They were like apartment complex that were townhouses, very similar to BTR. And that was one of the things that actually excited us about BTR. We like the fact that they have garages. People tend to fill them up with their stuff and they move less frequently. And in fact, our Knoxville property gets a rent premium if the backyard's fenced in because people like their pets and things like that. So when people move into a house, they don't necessarily look to find a house as quickly. So the turnover rate's a little lower. And the fact that it's new construction, it's still under builder warranty and things like that. And if someone moves out in the next year to 3 years, a lot of times it's just like a punch list. It's not like a major renovation when you have regular rental property. And I know that because I used to be a property manager. And years ago, I owned a painting company and I used to do apartment turnovers. I worked in construction for 22 years, right? So I know what's involved with some of that. And there's a lot of advantages in the build to rent space around these areas of lower turnover, lower maintenance cost. You do have on-site management and maintenance. These are nice communities, nice homes, and it's a predetermined market value for them. Now, they do tend to have a sale price lower than retail, but the developer knows that going in, but he also has a known exit, which is, in this case, PPR Capital, right?
So there's a lot of wisdom. Do you prefer to build from ground up, or you prefer to buy a certificate of occupancy? Because most of what I heard from your play is to get it to a stabilization point, whether you build ground up and then lease up, or you just buy it as CO and literally just stabilize and then sell to a long-term hold player.
You are correct, Mike. We tend to be a short duration investor in a lot of cases. Like I didn't mention our Austin project that's an affordable housing development. We're actually doing a second one there that's coming up. We're in and out of that project in a 2-year time frame. How much multifamily can you be in and out of, make a nice yield, and be in and out of in 2 years? It's not that many syndications do that, right? Syndications are actually tied up even longer right now. They used to be this very quick in the last several years, and then they're 3 to 5 years. Now it's 5 to 7 years. You might be in a syndication 10 years with very constrained yields going forward. And that's another reason we like build to rent. For us, it's like similar to multi, but with some distinct advantages. Now, you could argue you're taking on construction risk, and that's fair. That's a fair argument.
Well, what you just described is one of the big benefits of new development, or there's another equivalent to that is you could do a very heavy value add if the property is vacant, right? You could literally do the work. You can do heavy construction, and you have to be very comfortable, but you have no tenants. One of the benefits is if you have empty property, you don't have to worry about how many tenants renew, how fast you have to go, when folks move out to schedule work. So you basically at this point are in the business of execution on the construction site, right? And then you have an empty property to lease up. You're really in the marketing business, how to present the property best. So it's a niche. It's a very niche market. You're not dealing with existing assets. You don't get a big discount from real heavily motivated seller on existing property. You may get a discount on land, but land again is a portion, only a relatively small portion of the total cost. But you get the freedom and flexibility to run faster once you take control of the asset because you don't have existing tenants. It's a beauty and a curse. It's a different play. And I'll add one more comment. This is what I heard about BTR. I'm not a big expert. We've certainly done some BTR investments, but I'll tell you, it's a pride of residency, or pride of even if you're not an owner of the property, but it's the property feels like home. This is the beauty of build to R. Folks actually feel like they're living in a home environment versus an apartment environment, and living in the city. Apartments quite often are disliked because you have neighbors left, the right, above you, and you have to deal with the building rules and common areas and all that stuff. While if you are in a to our space. It's one of the advantages. Is it feels like home. It's honestly, like you said, gated backyard could make a big difference.
It's also renting by choice in a lot of cases. And I think that's something a lot of folks aren't used to. You know, there are people that want to move to a warmer climate or, I know in the Jacksonville area, build to rent's taken off pretty significantly, and they're filling them right up. And there's plenty of retirees willing to go to Florida. And instead of buying a home, they might have sold the big home, say in the Northeast or Chicagoland or wherever, and then they move to a place like that. And hey, they're on fixed incomes, but you know what? They don't have maintenance, they don't have headaches. If they have a bad neighbor, they can pick up and move. They have freedom, flexibility. There's a lot of positives that I think people, don't really fully appreciate like that. And some of these are 3 and 4 bedroom homes with 2 baths or whatever. And if you're, a couple my age, that could be appealing. And you have the 2-car garage and a little yard, and you have no maintenance, and you have all the amenities of the pool and the exercise and the walking trails. And there's something to be said for that. And it can be actually cheaper than owning.
Oh, big time.
And
one quick comment.
So I think it's a newer type of asset class that's going to be here to stay, I think.
Agreed 100%. The higher interest rates essentially forcing folks to, well, it's by choice. Maybe they can afford to buy, but the question is why, right? Why commit to an expensive mortgage when you can actually rent? Yeah, that issue. There are two factors: affordability, of course, right? And if you are more cost conscious, it's way less expensive to rent. And as long as the property feels like home, then it is by choice. So I agree with you 100%.
Yeah.
Any other thoughts on the space opportunities ahead? Is this still smooth sailing? I mean, these tariffs up and down, it's a temporary thing. It'll settle down after 90 days, and we'll have the new norm. Of course, crystal ball question. Well, it doesn't matter. It's like, okay, one way or the other, we'll settle down on something, and the space will still be an attractive space. So you're proceeding. Like, how do you know something is a great project? Obviously, demographics, all that stuff. Is there any other factor that may helping your decisions whether to do a project or not? And then we'll move to any other opportunities like car wash. Just curious to hear about that.
Yeah, I mean, a lot of what we do is we want best-in-class operators, best-in-class property management, and we want some type of competitive advantage in what we're acquiring. So I'll give you an example of that. We have a counterparty that we work closely with right now. One of the things that I call it secret sauce, like we like, just like I say, part of our secret sauce is our CIO and his allocation thesis and having a market watch forecaster on staff, right? That's a secret sauce for PPR. Well, the one BTR provider, for example, one of their secret sauce is in the area of architecture. So they have an architect, and that can be a huge advantage in design. That when you approach a project that could, handle maybe X number of units, well, he might be able to get X plus 10 number of units, or he might be able to design it in a way that's more palatable to the tenant or whatever. So I think there are advantages out there that are often overlooked, but we're always looking for those types of competitive advantage. Even in the NPL business, the counterparty that we work closely with, they have a trade desk in New York. They have connections with servicers. They have connections with institutional capital that make them, that's kind of the special sauce of working with them. So I think we're always looking for what's going to give us a leg up. What can we leverage? Because if you really think about it, it's all about leverage, right? It's all about what can we do to leverage the relationship, the capital, what have you, the knowledge, the experience. But yes, normally, same way in multi, we have one of our counterparties. They've been doing it over 30 years. In fact, our former CFO went to this partner, and that's how we got connected with them. We're still friendly with our former CFO, and he connected us to a counterparty that's been in multi well over 30 years. They are phenomenal to work with. Their reporting is stellar. Their execution is stellar. And that's the kind of thing we look for. Now, can you always find that? That's a different story, but that's what we're striving to do. And I think there's a lot of potential people that could be your partners, right? So, but if you can get best in class, that's really where it is. And if you think about it, PPR is built on company valuation. That's our focus. Our focus isn't on sales and revenue. Our focus is on company valuation. Sales and revenue will follow that. So everything we do, there's one goal, company valuation, right? The whole team's working towards that. In fact, our employees are owners of the company. So everybody's rowing in the same direction. Everybody's on the same, everybody's focused on the same goals and the same outcomes, right? The same core values, right? So I think that's important. And we do look for the similar core values in the counterparties that we work with, the various stakeholders, because we think that's important to, that they share similar values and that they want to make an impact, especially in the affordable housing space, the workforce housing space. Even in the NPL business, our goal is to keep people in their homes. It's not to take homes, for example, right? So it's all about that. That's kind of who we are. That's kind of the values that we represent, right? So I think that has a lot to do with it. And then, that's your shining star, so to speak, that North Star that you're all going towards and working towards, if that makes any sense.
No, it does. It makes great sense. You're aligning interest of, you have no employees, you have all stakeholders. Makes a big difference. People approach their job differently. Quick question. When investors give you a check, do you have one fund that does both, or you have two different funds with two different strategies, or one being notes, the other one being built to rent? Is it a single product with diversification done by you, or is it two different products?
Well, we have a Reliant Income Fund, which is NPLs and some commercial real estate in it. We do have a separate fund that is a minority. It's a small percentage of our portfolio, around 2% is in the car wash space. There is talk of doing a growth fund that has more tax advantages because, the Reliant Income Fund is more of a income play, and it's really known for diversification income, and it has some level of liquidity to it because it has a 6-month, 1-year, and 3-year options, right? So it can give people a little more liquidity than a typical real estate investment. And I think that's one of the advantages that PPR has, is because right now, like 2/3 of our business is this mortgage space. It gives us a level of liquidity that enables us to be a lot more nimble than a lot of other, real estate backed equity funds. They don't really have liquidity, right? They go out, they raise some money, they make an acquisition, and then they're tied up for a while, so to speak, in that asset until they can sell or refinance. Where in our case, we can actually recapitalize very quickly, either through our trade desk, through a securitization, and we also have a line of credit. We can drop mortgages on our line of credit, recapitalize, go out, make a purchase, make an opportunistic acquisition, right? Where I think that gives us a competitive advantage in the marketplace with, some of our co-opetition, I'll call it. So I think that is a plus for us that a lot of other funds don't have. And then that diversification piece. So that Reliant Income Fund is a truly passive real estate asset-backed investment. We're in our 18th year. We started in 2007. We have a long track record of doing this. It's something we've done for a very long period of time. I've been in real estate going close to 40 years now. And so have a lot of the team members. A lot of our team members have been at this a long time. Which is good. That's what you want. You want an experienced team working for you on your behalf. We take every investor's money seriously, whether it's family or friends or not family and friends. It's people's hard-earned money. This is their retirement money, that kind of thing. We do have a freedom fund, which is for qualified plan capital, primarily. People can avoid, UBIT and that type of thing. So yes, now there is talk of doing a growth fund, which would be primarily more traditional commercial real estate. They're looking into doing that more for creating a tax advantaged place for our investors to go to be a little more of a one-stop shop for folks with us. Now, our car wash fund does have tax advantages. That's one of the things about the car wash business. It has some unique advantages as well.
Yeah, let's quickly cover. We've covered quite a bit, and we have just a couple more minutes. So on the car wash front, so you said you have a couple of percentage points of your fund is in the car wash business, and then you have a separate car wash fund. So let's just talk about this. The fund what acquires land and develops car washes, or acquires existing car washes with land and assume the tax benefits. You run a cost sag and you depreciate, everything you can depreciate, something like that.
Yes and yes. So a couple of things. Whenever we venture into a newer category like car washes or BTR, it's never with large percentages of the portfolio. Does that make sense? So it could be 2% or even up to 5% over time, but that's kind of the way we tiptoe into things. And then if we go heavy, we go heavy, but we go in with both eyes open when we do this. So it's very intentional. But with the car wash, it's a half a dozen car washes in one fund. It is a construction play. And it's pretty much the McDonald's model, right? Where the hamburgers buy the valuable corner. These car washes are in various states, half a dozen locations. So there is some diversification that way. They're always on busy, valuable commercial corners near like Costco type stuff because they have to be. They have to be near where a lot of cars go by. And in this case, the car washes buy the valuable corner instead of the hamburgers. But there is some unique characteristics about the space. One of them is that subscription wise, it's roughly half the customers are subscription based. Private equity likes that. It's predictable. These are positive cash flow businesses once they're up and running. The other thing that's unique is a lot of robotics and automation, a lot fewer people. In fact, our current CEO, Steve Meyer, he formerly owned a car wash, for example. A lot of people don't know that, right? And when he had a car wash, there was like 25, 30 employees. Today, these are run with like 7 people. It's dramatically less. The other thing that's unique on the depreciation side is that the structure of the car wash, the tunnel and all, is considered to be part of the machinery. So that also accelerates the depreciation as opposed to the typical commercial real estate depreciation of, 39 years or whatever. So that kind of quickens that, whether you have bonus depreciation or not. Now, the other thing is these things make money if there's no depreciation. And that's something else I look at because I don't want an investment that only makes money based on after-tax implications. I want a profitable business model, whether there's a tax break or not. Does that make sense, Mike? That's all good and all, but I get kind of worn out with some of them where whenever I see somebody's pushing the tax advantages over the actual business model, I get a little concerned, right? But anyway, these are a franchise. The goal here is to aggregate these up. We're currently working with folks to build about 70 of these, and we're going to partner to basically group a couple hundred, hopefully, and sell these off to private equity in the next 4 or 5 years, which they're on track to do that. So, and the company that we get the actual tunnels through, they've been around for over 50 years. So our counterparty actually has board members from the original company that manufactures them. So we have a lot of unique advantages in the space, if that makes sense. So it's not like, we fell out of bed one day and said, hey, let's go try this. That's not what happened here at all. So we do like the space so far. Now, whether or not we go heavy into it, that'll be another story, but that's okay. It's just, it's an opportunity for the time being that we like. Yeah.
Yeah, I appreciate the explanation. It's a great niche. It certainly has both characteristics of an operating business and a real estate. And I like anything else, these type of businesses very much depend on location. Busy location drives all the traffic. It's the good old McDonald's concept. You're not in the hamburger business. You are in the real estate business.
Well, you bring up a great point. I'll give you an example. There's states we stay out of. This actual franchise, I'll give you an example of that. This franchise is actually in Florida, for example. And I live in Florida part of the year, right? So I get it. That's one of the states we won't go to. And you might say, well, why won't you invest in Florida with the same product? Because it's too easy to go into business in Florida. Too easy.
You don't have sustainable competitive advantage.
You go into some other locations, it's totally different, right? So I'll give you an example. Outside Philadelphia, for example, they're building one in Bucks County, which is just north of Philadelphia. And there's like 90,000 people within a mile of this car wash. And there hasn't been one built in like 25, 30 years. And it takes like a couple years to get an approval. Whereas some states, you go to Texas, you get approval in 90 days or something to build whatever you want. So there are situations where it actually makes more sense to go somewhere else. So it's just like anything else. You got to have knowledge, you got to have experience, you got to have the right, the right information, and really, be strategic and intentional about where you're going and placing these, regardless of whether that same franchise is somewhere else or not.
Yeah, I hear you, and I can, the only thing I can compare it to is another business that sort of in my head has some similarity, which is both operating business and real estate. It's self-storage, and there are places where they overbuilt. The protection mechanisms were not there, so they built a lot more facilities just because it was easy to get an approval. And you definitely want to be in a protected area as much as possible, because there's a lot of cost to build, and you don't want to oversupply the market. So if you are choosing a location to build either car wash or self-storage, and you don't have a protection mechanism, it's a higher risk versus it's difficult to get approvals. Once you get it, you went through all that aggravation before writing a big check. Yeah, that makes a lot of sense.
It's funny you say that about like self-storage isn't on our radar right now. And a lot of that is coming from The Economist because, well, you saw the slowdown in real estate and the number of people moving, that kind of thing. And it doesn't mean nobody's making money in storage. It's just we're holding off for now. It doesn't mean we won't expand into other verticals later, because our goal is to have a well-diversified portfolio as time goes on. But there's certain market conditions that make some asset classes better than others at certain periods of time. But I'll give you an example of competitive advantage, though. There's a gentleman I consult with on the storage side that builds retail. He's a developer that builds like the Main Street type retail that is like the new mall, so to speak, where malls are kind of, outdated.
Open air shopping.
Open air shopping. But what he does is he also owns a storage business. And his storage, he puts his storage in with the mixed use retail. And because storage doesn't take much parking, the municipalities love it. And he's able to actually increase the tax base for the municipality. And then he just puts the entrances in, less strategic, in hidden locations, whether it's the side or the back of the facilities, and they take up very little parking. So he found a way to do storage that's very unique, that's compelling.
Yeah, everything is a niche. Just the riches in the niches, right? That there's an expression.
Yeah. But then again, he has an architect on staff.
Sure.
Right? So
to engineer these
yeah, what are you doing, right? What are you doing that's different to give you that competitive advantage, even in a space that might be somewhat frowned upon in a particular market or whatever? Yeah.
Dave, thank you for sharing a lot of great wisdom nuggets. What's the best way for folks to reach out to you?
Probably the easiest is on our website, PPR PPR Capital MGMT.com, or on LinkedIn. I'm always on LinkedIn. Try to answer folks pretty regularly there. So thanks again, Mike.
Yeah, thank you so much for coming on a podcast. Thank you for sharing, and enjoy the spring.
You too. Take care now.
Thank you for listening to the Big Mike Fund podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnik. Keep listening and keep investing Big Mike style. See you on the next episode.